Hey everyone, welcome to the Icon and Spanish Shell case study. Thanks for taking the time tonight. Over the next 30 minutes or so, I'm going to go over why we bought this deal almost 2 years ago and how we executed the business plan, the challenges we faced and solutions, and the results delivered. So a little bit about me. I've been a real estate investor since 2002. I'm the president and founder of Break of Day Capital. I wrote two best-selling books, Best in Class and Invest Smart. So you can check them out on our website. I also founded a youth program where we were serving over 9,000 students daily throughout Southern California. And I started a nonprofit called Core Educational Services. We have a great team. Certainly, I don't do it alone. Sean heads up Director of Operations. Joe is Director of Investor Relations. Tim, our Director of Asset Management. Jacqueline, Operations Manager. And Andy, who's our Investor Relations Manager. This is our portfolio. We've had 4 exits so far and currently managing 9 properties and 1,400 units. These are our full cycle deals. The four deals, 3 of them in Tucson, 1 in Phoenix, and you can see the hold times and projected IRRs and equity multiples and the actuals. So Icon and Spanish Trail, we bought in 1979, 256 units. The purchase price was $33 million, and we paid just under $129,000 per unit in December 2023. What we liked about this property is it's institutional grade. And what I mean by that is a buyer that is well-heeled will be very attractive to this deal because of the size and the quality of this deal when we go to sell it in 3 to 5 years. At the time we bought it, things have changed drastically since 2022. Capital raising really, was came to a halt, and there was a lot less people lending at the time. And deals like this would probably be 25 to 30% more if you bought it in 2022. And so I love the discount that we're buying it at. And also we had a comp that was bought earlier in the year for $149,000 per unit, C class and 57 units. So no economies of scale. Where here we're having massive economies of scale by buying 256 units, and obviously it was significantly cheaper and a higher quality asset. The sellers also put in $3 million roughly over the last few years, so they kept it in really good shape. And there was still some meat on the bone for us as well. And Tucson is a market that I think a lot of people fall asleep on. It doesn't have as many highs and as many lows as Phoenix. So it's a nice steady market, and we knew the market really, really well. And just to give you context, when I talk about when we bought this in 2023, in 2022, there was 27 deals, I believe, that were 100 units or more that sold. And in 2023, there was only 3 deals that sold. Our deal, that 57 unit, and one other property. So deal flow had drastically dropped off. Okay, so our business plan was a water savings plan. So when we looked at the T12, the financials, and saw the expense for water, we knew something wasn't right. Did they have a leak? Did they not have low flow toilets and shower heads and faucets? And so, we had a picture and we showed it to a plumber, and he saw the toilet that he realized it was 3.5 gallons per flush. And we can install toilets that are 0.8 gallons per flush. So massive savings to be had there. They also had a dog park, but no dog park equipment. So that was something that they needed. Doesn't cost much, but would add nicely to the amenities at the property. They also had more staff than what we would typically have at a property this size. So we knew we can reduce the staff and still run it a quality asset. It also didn't have privacy fences along the patios. So there's 128 patios and no privacy fences. So we thought if we can install these privacy fences at a really reasonable cost, just under $1,000 per unit, we could charge $75 per unit when the new lease started. So we knew there was a very small cost and a very, very big gain to be had. Also, we wanted to paint the property. It was brown throughout, and I'll show you some pictures soon. And the cost was relatively cheap because we didn't have to repaint the whole property. We ended up we allocated a lot more money for paint, but we ended up spending a lot less because of what we did. And we also allocated a lot of money towards renovating the remaining 40% of the classic units. And that was a struggle of ours, which I'll get to later as well. So here's our renovation budget. Like I said, $100,000 for paint. We had $200,000 for landscaping, which we barely used because we were able to accent some other areas. We had money for new signage because we changed the name from the place at Spanish Trail to Icon on Spanish Trail, which is a moniker that we use. They also had a drainage issue years ago, and so we put $20,000. That was a bid that we got to they had fixed it, but we wanted to go even further than that to make sure we didn't have an issue. We also put money in for reserves because things always break. Hopefully not everything breaks, but we have money in there for things that do break, like plumbing, roof, HVAC. We also had money for pergolas. You probably can't see. I'm going to point out like just above the pool area, there's a barbecue area, and we thought we would put pergolas in there, but at the end of the day, we ended up saving that money as well. We did spend a little bit of money on the pools, fixing that up and pool equipment. And then we also always have contingency and then construction management fees on top of that. So very padded renovation budget, which I'd rather have that money up front and not use it versus need it and not have that money, and then you have to use cash flow or raise more money. So always better to pad. So this is our implementation and the result. So I told you about the toilets, but we also replaced shower heads and faucets with aerators. So you're using 2.5 gallons per minute down to 1.5. So massive savings. Actually, 138,000 was the savings that the plumber thought we would get, but we actually got more than that, which was huge. Massive savings for I think it cost 100,000, but minus the rebate, we were out of pocket 55,000. So within a few months, we made back that money and increased the value of the property significantly, because when you take the savings divided by the cap rate, that's where we got the $2.76 million. And then with the extra person that they had, we saved 60,000 on top of that. We also were able to save the insurance $50,000, which was massive. And then adding the privacy walls, which takes time to absorb. We don't get to charge 120 units, $75 a pop from the beginning. But as those units come for renewals or we add a new lease to it for a new rental, then we're able to charge that money. And residents actually, they want it and happily pay because they want that privacy. They could put out different things in their patios that so it really creates a lot more space for them versus if they're just leaving it out and anyone could hopefully not take it, but certainly again they don't have that privacy. It's not their particular space. So here you can see the NOI grow over time. The blue is when we took over year, and it's a steady growth, but it's like every property of ours, it's not a straight line up and to the right. There's some months better than others, but a massive growth over $537,000 in 1 year, representing a 36% growth in year one. And across the board, we've averaged about 40% across our portfolio in the first year, in NOI. And we've done a really good job about finding properties that have a lot of meat on the bone. These days, we're not seeing as much as that. We're seeing deals that maybe cash flow a little bit more, which is good, and less improvement, particularly because you're not able to renovate units and get the bump during this current state. Now that should change in the next 6 to 12 months. So wins and struggles, very high retention. We had a really good property manager in there, who helped keep renewals high, which reduces our costs because we don't have to turn over the unit. We don't have to spend marketing money and time it takes to get someone in. And we also had minimal delinquency. It led our portfolio in the least amount of delinquency. And quite honestly, that's a part of credit to the seller that they really had good tenants in there and treated the property well. And so that really helped us. So struggles, every deal doesn't go perfectly. I wish it did. Even the deals that we've made tons and tons of money on, we've had plenty of struggles. This is a business, there's ups and downs. And we struggled with occupancy in the beginning. We were in the mid to low 80s for a bit, and it took us a little bit of time, brought down some of the rents and got our occupancy up to where it should be. Obviously, I said we weren't able to push rents, but we did focus on the controllables, and the controllables were the expenses, the things that we could control, and saving money on the insurance, on some of the expenses, on the water, stuff like that. Um, like I said, renovate a lot less units, and raising capital was a big struggle on this property. Coming out of 2022, a lot of people had put in a lot of money into deals, and that deal flow tightened up. Nothing was selling, so investors didn't have the liquidity, and certainly there was a lot of unknown at the time. Hey, there's still unknown now in today's market, but raising capital was really tough, and it took us a long time to raise the money for this deal. But we were very confident in this deal. Like I said, great basis, great upside, which we were able to do so far. But we'll call it a success when we sell and earn a lot of money for our investors. That's when it's all said and done. That's the tale. It's not a year into the project or 2 years. It's ultimately when you go to sell. So I talked about paint, and so on the left is the before picture. It was kind of like a backgammon, and it just didn't look right. And we came up with a lot of different scenarios of how to change this. And then finally, we're like, let's not mess around. Why don't we just paint over it and it'll be fine versus all these different color schemes? And it worked really well on the right. You can see, we didn't need anything fancy. And we were able to save a lot of money. So on the left, also you'll see there was a lot of brown paint on this property, and didn't want to paint the whole property. So on the right, you could see we added that kind of like burnt orange look to it, on the trim and on the patios. And you could see the new privacy patio fence that we put in. And then on the stairway to the right, we changed it from brown to like a charcoal. So um, it's hard to nail the paint schemes, but it definitely brightened up the property. It really gave it some pop, which it needed. And then here on this slide, you can see other things that we did. So you've got the new signage for the property on the left, icon on Spanish Trail. And on the middle center picture, the property didn't have a fence separating the street from the parking and the property. And so I like to call this a faux fence. And I saw this at another property, just a very, very small version of it on the in front of the building. And I thought, well, what if we kind of 10x it and put it to separate from the road? And so we have, I'm just guessing, maybe about 25 of these. Yeah, so we have one and then another like 20 feet and then another one. And it creates like a visual appeal to it and also some separation from the road to give it a little bit sense of security to our residents. Moving to the right, we added this signage in the clubhouse. And believe it or not, in today's society, it's still worthy. We have new residents take pictures in front of that at all of our properties. So it's kind of neat. And then as you move to the left, you'll see the privacy patio. People put out their furniture, a nice rug. And then when you move to the left, so we weren't getting the rent bumps on the renovation, so we weren't doing them, but we did add a washer dryer. Everyone wants a washer dryer in their unit. So we didn't have room really for a stackable, and they need a vent. And so this product costs $2,000, and it's a ventless washer and dryer in one. And back in the day, these weren't made very well, but we got some feedback that they had been much improved. The reviews, over 2,000 bought on like Home Depot, were really good. So we took a chance on one, and that worked out well. And then we started adding more. So that's a controllable that we can do. People aren't going to pay extra for an improved, a renovated unit, but they will pay extra for the washer dryer. And so we've rolled these out more and more, relatively slowly, to make sure we keep renting them up at the extra unit cost. So here's another picture of the before and after. Whoop, I'm going backwards. Sorry. All right, capital stack and use of funds. So on the left, we raised almost $10.5 million over many months. We had a preferred equity partner come in with $7.1 million. And then our senior debt was a $20.8 million loan. It was a 2-year plus one fixed rate debt at 7.95%. At the time, there wasn't a lot of options for debt. This was relatively expensive debt, but it still worked in our underwriting. So again, found a good deal, found debt that could handle that deal, and so we went with it, and it had a minimal prepayment penalty, low fees, and with a lender that we've worked before and liked working with. So now we're almost at our 2-year mark. We are in the middle of refining this property. We'll be able to get a loan for $23.5 million now at 6%. Again, this will be a 3-year loan, minimal prepayment penalty, which we like because we still want to be within that 5-year period. Low fees again. And we are bringing in a new pref partner at a smaller amount. So we replaced pref at, let's say, 16.75%, $1.1 million and turned it into the senior at 6%. So a big savings there. And also our new pref partner has a lower rate. So we went from 16.75 on the amount that we're using to 15.5. So not a big difference, but definitely some savings there. And then obviously on our senior, a massive savings. So community is very important to us. When you build community on a property, residents stay longer, they work together, they clean up better, better care of their units. So it's really important. And obviously the residents really enjoy when we do events, and we do them on a regular basis. We like to create win-win scenarios. So a win for our residents and a win for our investors. And our residents typically stay longer at our properties than the national average, and we're very proud of that fact. All right, so key takeaways: rent growth won't carry deals anymore. Even just a little bit of overestimating your rent growth really messes with your returns. So when you're underwriting, you have to be really careful, or when you're investing with others, you have to be really careful. So what we did, our focus shifted to managing costs and maintaining occupancy to drive NOI. Operational efficiency is the new alpha. So we focus on consolidating roles, optimizing utilities, and reducing insurance costs. And that's something that we constantly do. Just because we do it on takeover, we're still doing it. We're implementing a lot more AI tools to reduce staff, save them time. We could centralize things. Really helps. Stability is a feature, not a flaw. So success came from controlling the controllables and creating new income streams and not chasing aggressive rent growth, which we wouldn't, if we just relied on that, we would be we'd be in a load of trouble. And timing was important. Our basis is great when we bought the deal, but execution mattered more too. We drove the value of the property up so much more. And like any business, there's ups and downs. Like I said, constant challenges. We didn't certainly, as I discussed, didn't do everything that we planned to do, but we did what we can control to maximize the value. And I'm blessed with a great team here at Break of Day Capital, and also my property management team as well, that are the boots on the ground. It's a team effort, and thankfully we have a really good team to implement our plan and to pivot when we need to pivot. So the case study that I talked about really highlights our approach and how we execute in any cycle. And the good news is we do have some similar investments available right now. So if you have money stuck in a money market account or you need liquidity, we have two options for you. We have a Class A, which is an 8% annual return paid monthly with 90-day liquidity. We also have a Class C, which is a 12% annual return. 6% is paid on a yearly basis, but paid monthly. So 0.5% on a monthly basis, and 6% is accrued. And for those looking for bonus depreciation in 2025, we still have a little bit of room left on Icon on Headley. It's a 1999 deal that we bought earlier in the year, already paying distributions, and you get an 84% bonus depreciation for 2025, with more depreciation coming the years after. So if you invest $100,000, you'll get an $84,000 loss on your K1. Now, not everyone can use it in the first year, but it's something that you can use potentially when we sell, or just carry forward it to another year when you do have passive losses. So just check with your CPA if you can use it. But that's the beauty of real estate, the bonus appreciation, because it really, when you're looking at our internal rate of return or our average annual return, that doesn't even include the tax benefits, which rocket fuels your net worth. So we can discuss all these things and be on this for another hour. But the best way to do that, if you're interested, is to book a call with Andy, our investor relations manager. You scan the QR code to book a call with him. And you'll see his email on there as well, Andy at breakofdaycapital.com. He can answer all of your questions.